Hello and welcome to BullionStar AMA. My name is Ronan Manley, and today's question comes from an anonymous submitter and is, who or what determines the spot price of gold? Well, the spot price of gold is a real-time gold price which is derived by a group of bullion banks and brokers who transact vast quantities of a trading unit known as unallocated gold. Now, some of these bullion banks you'll be familiar with are the likes of Goldman Sachs, UBS, HSBC, JP Morgan, and some of the brokers that they work with in trading this unallocated gold are companies, interdealer brokers such as Marex Spectrum and Tullett Prebon. Now, all of these banks and brokers are members of the London Bullion Market Association, LBMA in London. And while the spot trading of unallocated gold is centred in London, it also happens via the trading desks of these same banks and brokers around the world. So I think it's critical that people get a feel for exactly what is unallocated gold, because it's a misleading name, because despite the name, it has absolutely nothing to do with physical gold. Literally, unallocated gold is gold credit which is created out of thin air by a bullion bank. So for example, if I'm an institutional investment firm, a buy-side client, and I want to get exposure to the US dollar price of gold, I will go to a bank like Goldman Sachs or Citibank, UBS, and I will say I would like to buy unallocated gold. So I pay cash, US dollar cash, and the bullion bank literally creates unallocated gold out of thin air and allocates it to an unallocated account that they open in my name and they maintain. So I end up with an unallocated gold balance, and literally that is a claim that I have against that bullion bank for delivery of gold. And the bullion bank likewise, vice versa, has an obligation liability to me for that amount of gold. But literally, the gold that the unallocated gold that the bullion bank creates has no bearing on the amount of physical gold that they might have in the vault in London or elsewhere, and no bearing on the London gold stocks in total, or even the gold stocks of other banks in the LBMA. So literally, this is fractional reserve gold banking in the same way that you might be familiar with fractional reserve commercial banking. And so you can call this gold credit, unallocated gold, fractional reserve gold. It's also called screen gold because literally these banks and brokers are trading the gold price against US dollars on screens around the world, so they call it screen gold. Denton's, the global law firm, which is has its headquarters in London, has even described unallocated gold as synthetic gold because in their view, legally speaking, there is no intention of any of these holders to convert their unallocated gold into allocated gold. And so it's a cash settled transaction, which they call a derivative. So it's a derivative, it's synthetic paper, screen gold, fractional reserve gold. But despite this, it is the official trading unit of the London gold market. And everything from the spot contracts to forward contracts to swaps to options to the gold deposits that central banks lend out their gold to the bullion banks, everything is denominated in this unit of unallocated gold. And not only that, but these same banks and brokers are involved in the COMEX gold futures trading market in New York. And they dominate that market and they dominate the London gold market. So they trade unallocated gold, they trade gold futures, and there's a huge feedback loop in real time between the two pricing structures of the COMEX market and the London market. And not only that, but the LBMA daily gold price auction is also priced in unallocated gold, the unit of trading. So everything to do with the structure of the trading, settlement and clearing in the London gold market, in inverted commas because it's not really gold, is to do with unallocated positions which are created out of thin air. Allocation is a totally separate process. If you want to allocate your unallocated position, you go to a bullion bank, and after they probably panic, they will say they might be able to allocate it. And it's an actual different team, physical operations team in these bullion banks, which does the allocation. It has nothing to do with the trading that you will hear about of the London gold market trading in the LBMA market makers. So, and these sums that they trade are vast. even based on the LBMA's trade statistics. For example, in Q2, the average daily trading volume of gold, unallocated gold, was something in the region of $80 billion per day, which is over 40 million ounces equivalent per day, which is about 1,300 tons per trading day equivalent. So if you annualize that, that's over 300,000 tons of gold equivalent. And there has only ever in history been over about 200,000 tons of gold ever mined. That's the above ground gold stock that's known to exist. And the annual gold mining supply is only around 3,000 tons. So on an annual basis, these people in London and the LBMA bullion banks are trading 100 times more than the annual supply of gold mining, and over 50% more than all the gold, the real gold that has ever existed. So basically, these prices that you see being the spot prices are based on continuous quotations that these banks and brokers provide to each other or quote to each other in London and elsewhere, which then get picked up by price feeds and go out around the world as the price feeds that feed into everything from a Bloomberg terminal to a Reuters terminal to the CNBC ticker price of gold that you'll see on the financial news channels. So literally everything that I've said about gold applies to silver, because the London silver market is also an unallocated silver market where these same banks and brokers create unallocated silver out of thin air and then trade it in vast quantities. So really, in summary, who creates the spot gold price? Well, it's these banks and brokers in the LBMA. And how do they do it? Well, they do it by creating vast quantities of fictitious fractional reserve gold, i.e. unallocated gold. So what are some of the implications of this? Well, if you think about it, the whole structure of the gold market, the whole structure of pricing is flawed, it's artificial. And it's because they are trading a unit of trading that has nothing to do with the physical gold market. So if the spot price of gold falls suddenly, which it does quite often because of these banks trading in London and COMEX, then there is a huge pickup in physical demand for gold at the retail level and at the wholesale level. But in a free market, what normally happens, if there's a constant supply and a huge increase in demand, then the price will rise, the physical price would rise. But that doesn't happen in the gold market, because the physical gold market and physical silver market have no bearing on the spot price, because the spot price is created from unallocated trading by these banks and brokers. So really what you have is a situation where physical gold demand, which otherwise would have flowed into physical gold supply, gets instead siphoned off into this artificial supply, which is expandable at will by these bullion banks. And we all know about the criminal fines and prosecutions of bullion bank traders in New York, for example, for manipulating COMEX silver and gold prices. And that's one form of manipulation. But what's not really appreciated is that really on a fundamental level, the whole structure of these gold and silver unallocated markets is flawed. The whole setup, the whole market mechanics is designed by design to siphon off demand that would otherwise have gone into physical metals and instead put it into artificial supply. So thank you for watching. Be sure to follow us if you like this video, and hit like and subscribe, and keep these questions coming in, and we'll see you in the next video.